Thom. Is it Thomas? Okay, it's just T-H-O-M. I thought it was going to be Thomas, but it didn't spell out the whole name. So Thom says, you had mentioned a broken stock to get back to break even. Can you give us an example? Okay, well, let's just use, we probably can't use on, but we're going to try to. Let's say that I was in that on semiconductor position, but not as a married put. Based on the portfolio we saw, let's say that I actually had bought ON at just a share price of $22.77, used no stop, used no married put, and let's say that I just used 100 shares. As we saw, it's now down to about 14. So I'm going to go to the stock repair tool. We've got it at $14.50 right now. So I'm down about $8.20 on the position. Now, because this one is a lower price stock, and it might not work with a, oh, sorry, folks, it might not work with a higher price stock, depending on what capital you have available, Thom. But in that Manage Your Broken webinar, we also discuss, because this is a lower, as Sam mentioned, this might be a good idea to actually buy another 100 shares at the low cost of, let's say, $14.50. It might be higher on Monday. Let's hope so, but let's do this. Buy another 100 shares at $14.50. So that's going to take my total cost of the ON position down to $18.64, let's call it. And we're going to use 200 shares, right? So I'm going to buy another 100 at $14.50 plus my $22.77 cost base, and now have 200 shares with the average cost of $18.64. I average down first, then I run the stock repair. Still nothing. It's still too depressed. That's okay. It also depends on what strikes are available. So it's looking for the debit repairs on ON. Of course, I could add another 200. I could keep doing that if I wanted to, another 200 shares. It's a lower price stock. So, you know, we're at $18.64 for 200 shares. We had another 200 at $14.49, I guess, $14.50, let's call it. We average down again. That would take us only down about $16.58, $16.56. Okay, but now we have 400. Could a repair be done? Not always the best advice. That's very strange. The strike prices, it's not giving us the right ones we want. Now, Costco is a good example. It's probably a better example. So as we know, of course, everything had a strong fall, and Costco rebounded back today to 302. Let's say I originally bought shares of Costco at $335. Right before things started to go bad, it went as low as $280, remember, Thom. So what I'll do there is we'll plug this in. Now, near term, tons of Aprils because of all the weeklies and the various strikes. But it shows NA. It's trying to build this ratio repair to get me back to break even, but it's not there. Okay, that's what NA means. Oh, but being $30 or so down on Costco, we do have a repair we could use out to May expiration. And so it shows me when I see the repair details and analyze trade, let's click on repair details. How would this work? So we have a cost basis of $335. And right now, Costco's back up to $302.30, roughly. Okay, so we've got a $3,273 loss on the stock. The repair shows me that we could buy one May 300 call for a price of $29. We could also sell two May 315 calls for $17.65, which would bring in $3,500. So we get a net credit of $630. But my break even now is cut in half, isn't it? Instead of needing the stock to go from 302 back up to 335, it only needs to go up 12 points to 314. How's that possible? Well, what did we do here? We bought a 300, and then we paid for it by selling two 315 strikes on a stock trading at 302. We lower the cost by $6. We'll say, wait a minute, that's going to put you at 329, Mike. That's 630. Okay, 328.70. In that case, that's nowhere near 314 break even. But I have a 300 call. And if the stock's at 314 at May expiration, that call is going to be worth $14. So $14 plus the $6 net credit, in that case, that's going to get me back. And we scroll down here and it shows. So at 314, what do we have? We've got a $20.65 loss on our stock from our purchase price of $335. The long call would be worth $14.35. And we keep the 630 on the position, net credit deposited in. So sell to close the long, the shorts expire worthless, we keep the 630. There's our 2065, we're back to break even without needing the stock to go all the way back up to 335. And of course, we could even get some profit in this position if it's trading right at 315. Not a lot, but you'd still be 15 points underwater in this, 20 points underwater in this case without using the repair. Now that's the numerical breakdown of what's available there, Tom. If I wanted to see it graphically, just click on Analyze Trade here. That takes you to our profit and loss chart. And no, of course, Tom, nothing here is naked. Yes, you're doing a ratio spread. You're selling 2 calls and you're buying 1, but you own 100 shares. So what you're really doing in this case is you're taking your long shares of stock and adding a covered call at the 315 strike, while at the same time doing 1 bull call debit spread at the 300 to 315 strikes on Costco, and you're getting paid $6.03 for this debit spread, essentially is what you're looking at. Okay, that's what the ratio is giving you. It's giving you that positive net credit. It's collecting in $34, $35 here, $6 over the cost of the $29 for your 300 strike. And of course, as I mentioned, we want to scroll down now and take a look at it. There we go. So not a lot of profit here, of course, if the stock's above 315 in this case. But again, if I did nothing, and just by May expiration, I know that's pretty far away, but at May expiration, the stock's at 315, I'm still $20 in the hole. In this case, I'd be back to break even, and I can exit now the bull call debit spread for the 15 points back, either sell to close the 300 and buy to close 315, or just let my broker close these 2 legs together, and I can roll the extra call up, 320, 325, continue to trade it as a covered call to hedge it. But in these uncertain markets, as you saw, what I'd like to do in addition to this is probably buy that put option, the married put structure, to help me avoid and mitigate the volatility of these wild swings. Oh, okay, this brings up another good point here. A comment had also come in later. Is there a way to protect the portfolio? Yes, we've been talking often over years and over months specifically prior to this about ways, and you can see it here on my portfolio. Why do I have the VIX selected here? Why do I have VXX selected here? On my other account there, we also would show UVXY in my pods also. And these are the ways to hedge the market. We've talked about it before. In addition to most of my portfolio, 40 to 50% of my trading portfolio for options being just in the married put technique, with owning stock having that limited 5 to 6% risk available. There are portions of my portfolio that are diagonal call spreads and bull put credit spreads, which in a condition such like this can quickly lose 100% of your value. You could lose 100% of what you invested in the diagonal spread. As Sam had mentioned, he's interested about the gentleman who was talking about the leap options, the calls and the puts, and sort of the double diagonals, and how did he adjust those positions. I haven't talked to him about that yet, Sam. I haven't heard from him this week. In any case, but for a bull put credit spread, you say, oh, well, it's a known risk, so it's not really a risky position. It is a known risk. But if you do the wrong position size, you have to know you can lose 100% of this. I haven't opened any bull puts in about 20 days, 15 to 20 days. I think it's right around 3 weeks. I haven't opened any bull puts because the market conditions were wrong. I took a couple of losses which were protected. The losses I took on the bull puts that I had opened when this started about 3 weeks ago was countered by the gains I had in the VIX calls. And I'll admit freely, I got out of most of those probably too early. I think I got out of most of those when the VIX was at 28, 26. I think it was the highest that I had one last VIX call remaining and got out of it. In that case, I didn't buy new ones then because I thought it might be too expensive. But again, as I mentioned, what was left in my portfolio is mostly the married put trades and a couple diagonal spreads, and the married puts are positioned perfectly. I could have done better, as Jerry did, by adding income method number 12, but they're still in a perfect position. Ones I'll close now and take the profits on, and the other ones I'll manage to go forward and turn those into a profits when and if the market recovers. But portfolio protection, puts on SPX and SPY, buying calls on the VIX, or what Sam prefers to do is shares of UVXY, or a contra ETF. Also to profit in Sam's case, but it's also a market hedge to buy a few shares. VXX is one of them. You've got the inverse SPY, the 2 times bearish and 3 times bearish SPYs as well. And we recently also posted a presentation on revisiting what we called stock or portfolio insurance, which is on the blog here. And so if I go to the blog, just blog.powerop.com, I could just do a rough search for stock or portfolio. You guys should have gotten this email a couple weeks ago. We're just revisiting we presented some new information, and then we wanted to go back to the old information. And this one's for stock traders, portfolio insurance, and it talks about ideas on buying puts, the cost of buying puts on SPY or SPX, why it's really not as high as you think, because you're not protecting 100% of your portfolio. What do I mean by that? Well, if you were expecting a 20% decline and you wanted to minimize the loss to only 5%, you're not buying one-to-one with the total shares in your portfolio. You might only be buying 15 to 20 to 25 puts on SPY, which may sound expensive, but the amount of money it would save you, you still might be down 5% on your total portfolio, but you hedged most of that. And it wasn't even that much of a cost to protect a $200,000, $400,000 portfolio. Even a $50,000 portfolio, you might only be buying 5 or 10 contracts. It's not as expensive. And this one goes in depth into the other ideas as well, talking about the cost. But this was just more of a video, breaks down the costs, outcomes, pros and cons of the different strikes you can use to insure a portfolio, and ideas on using the volatility ETF shares, contra ETF shares, or calls on the VIX to help you hedge as well. SDOW, Sam mentions, is one of the other ones. SPXS and SPXU are ones he showed me a screenshot of that he was in earlier this week as well. Okay, so that's the other idea. I think that's the best place to go. Go to blog.powerop.com, just do your quick search there, as you saw, for stock or portfolio, and it'll come up with part 1 and part 2 there, the stock or portfolio insurance. And if you've kind of dabbled around in those before, you don't need to read part 1, just jump right into part 2 there, that video there that goes through the math, the different examples, showing a sort of a chart, or I should say a graph there, of comparing, number of strikes in the money and out of the money versus number of contracts and hedging, to give you more of an idea of what you might want to consider if you fear things turning around or things getting worse over the weekend and Monday opens opposite of what I had thought happened. Yeah, the VIX almost got up to 70, Sam. I know the UVXY 65, I think you said. I wasn't watching it as closely, but I think that was up to as high as 65 at one point. And you got out of VXX at 45, okay, so they pulled back a little bit in that case. Good, good. Oh, yep, sold UVXY at 65 today. Now I'm not going to buy at this price. Agreed. I'm not shorting it either, and I'm not buying puts on the VIX because they're too expensive. The volatility of the volatility is really high, so I'm not going to buy puts expecting this to go down further because of the high cost. If it starts to turn more convincingly, may look at a bear call credit spread on this rather than just buying a put. Or, safer play, maybe, Sam, as you mentioned, instead of trying to play options on the volatilities, which are now very high, is just buying back into bullish ETFs 2 times or 3 times. Maybe pick up 10 shares instead of 1 contract and treat that as an option that doesn't have any time value decay or fighting against a implied volatility collapse either. It's a good approach to use. That's sort of what's in that discussion there of why is it sometimes beneficial to maybe just buy shares of an ETF, a volatility ETF, an inverse or contra ETF when you think the market's going down. I prefer the VIX calls, and I think Sam sometimes does that too with VXX and UVXY, because you get a much more rapid percentage increase with the options. But again, on the way down, because the cost of the puts are now so high on the contras and the 2 times and the volatility ETFs, it may be better just buy shares of the bullish ETF now, where you're not fighting an implied volatility decay, you're not fighting an inflated cost due to volatility. You're just buying something that's depressed and to go forward. So both are viable plays, but it gets trickier now to buy puts on some of the broad-based ETFs, indexes, or volatilities because of the increased implied volatility adds to that extrinsic cost. You might need a larger move to get to a profit. Might just be better if there is a sustained move to buy something that's not having time value decay against you, but still helping to push you back to the break even on your portfolio, say shares of an ETF, for example.